Question 1. The review process indicates that an insurance underwriter, who is responsible for evaluating a significant commercial property insurance application, has recently learned through a personal connection that the applicant company is on the verge of a major, undisclosed acquisition that will substantially increase the value of its insured assets. The underwriter's spouse holds a substantial number of shares in the applicant company. The underwriter is considering whether to approve the application at the current premium rate, believing that the undisclosed acquisition might justify a higher premium, but also recognizing that approving it now could be seen as a personal benefit if the spouse's share value increases significantly post-acquisition. Option A. Immediately disclose the potential conflict of interest to the compliance department and the underwriter's supervisor, and recuse themselves from the decision-making process for this application until the conflict is resolved. Option B. Seek informal advice from a senior underwriter on how to handle the situation without formally reporting the conflict, and then make a decision based on that advice. Option C. Approve the application but recommend a review of the premium rate after the acquisition is publicly announced to ensure it reflects the new asset valuation. Option D. Proceed with approving the application at the current premium rate, assuming the personal benefit to the spouse is indirect and unlikely to influence their professional judgment. The correct answer is A. Immediately disclose the potential conflict of interest to the compliance department and the underwriter's supervisor, and recuse themselves from the decision-making process for this application until the conflict is resolved. Explanation. This scenario is professionally challenging because it involves a direct conflict between an individual's personal financial interests and their fiduciary duty to their clients and employer. The temptation to leverage non-public information for personal gain, even if seemingly minor, erodes trust and violates fundamental principles of fair dealing and market integrity. Careful judgment is required to ensure that all decisions are made in the best interest of the client and in compliance with regulatory requirements. The correct approach involves immediate disclosure of the potential conflict of interest to the relevant parties, typically the compliance department and the client, and recusal from any decision-making processes that could be influenced by the personal interest. This upholds the duty of loyalty and ensures transparency, which are cornerstones of regulatory frameworks designed to protect consumers and maintain market confidence. Specifically, regulations like those governing financial advisors and insurance professionals mandate the identification, disclosure, and management of conflicts of interest to prevent them from adversely affecting client interests. An incorrect approach would be to proceed with the investment without disclosing the conflict. This is a direct violation of regulatory requirements and ethical standards. It demonstrates a failure to act in the client's best interest and prioritizes personal gain over professional obligation. Such an action can lead to severe regulatory sanctions, including fines and license revocation, as well as reputational damage. Another incorrect approach is to rationalize the action by believing the personal gain is insignificant or that it won't impact the client's decision. This demonstrates a flawed understanding of the pervasive nature of conflicts of interest and the regulatory intent behind their management. Even a small personal benefit derived from inside information or a situation where professional judgment could be compromised is unacceptable. The regulatory framework is designed to prevent even the appearance of impropriety. A third incorrect approach is to seek advice from a colleague without formally documenting the situation and the advice received, and then proceeding with the action. While seeking advice is generally good practice, failing to follow established procedures for conflict resolution, such as formal disclosure and recusal, renders this approach inadequate. The regulatory framework requires a structured and documented process for managing conflicts, not informal consultations. The professional decision-making process for similar situations should involve a clear, step-by-step framework. 1. Identify the potential conflict. Recognize any situation where personal interests could influence professional judgment. 2. Assess the materiality. Determine if the conflict is significant enough to potentially impact client interests or regulatory compliance. 3. Disclose. Immediately and transparently inform all relevant parties, employer, compliance, client, about the conflict. 4. Manage or recuse. Follow established company policy and regulatory guidelines to manage the conflict, which often involves recusing oneself from the decision-making process. 5. Document. Keep a record of the conflict, the disclosure, and the actions taken. Question 2. Cost-benefit analysis shows that a proposed reduction in underwriting standards for a specific product line could lead to a significant increase in policy sales and a reduction in acquisition costs. However, the actuarial team has identified a potential for increased claims frequency and severity due to the relaxed underwriting criteria, which could lead to adverse selection and impact the long-term profitability and solvency of the insurer. The actuary is tasked with advising on the appropriate course of action. Which of the following approaches best aligns with actuarial principles and regulatory expectations for managing this risk? Option A. Proceed with the underwriting changes, but focus solely on the projected increase in sales volume as the primary justification, downplaying the potential negative impacts on claims and solvency in internal reports. Option B. Conduct a thorough actuarial analysis to quantify the potential impact of adverse selection and increased claims costs. Develop revised pricing models that reflect the higher risk profile, and present a recommendation that balances market opportunity with financial prudence and regulatory compliance. Option C. Implement the proposed underwriting changes to capture market share and reduce immediate costs, assuming that any increase in claims can be managed through future premium adjustments. Option D. Reject the proposed underwriting changes outright, prioritizing the preservation of current underwriting rigor and avoiding any potential increase in claims volatility, even if it means foregoing potential market growth. The correct answer is C. Implement the proposed underwriting changes to capture market share and reduce immediate costs, assuming that any increase in claims can be managed through future premium adjustments. Explanation: this scenario is professionally challenging because it requires an actuary to balance the financial implications of a pricing decision with the regulatory and ethical obligations to ensure fair treatment of policyholders and the solvency of the insurer. The actuary must consider not only the immediate cost savings, but also the long-term impact on customer perception, market competitiveness, and compliance with prudential regulations. The correct approach involves a comprehensive assessment that goes beyond immediate cost-benefit calculations. It requires the actuary to consider the potential for adverse selection, the impact on customer retention, and the alignment with the insurer's risk appetite and strategic objectives. Crucially, it necessitates adherence to professional actuarial standards and regulatory guidance, which emphasize the importance of sound actuarial principles, including the adequacy of reserves and the fairness of pricing. This approach ensures that the insurer operates on a sustainable basis while fulfilling its duties to policyholders and regulators. An incorrect approach that focuses solely on maximizing short-term profit by underpricing risks fails to account for the potential for adverse selection. This occurs when individuals with a higher-than-average risk are more likely to purchase insurance, leading to higher claims costs than anticipated. This can erode profitability and potentially jeopardize the insurer's solvency. Such an approach would violate the actuarial principle of ensuring that premiums are adequate to cover expected claims and expenses, and would likely contravene regulatory requirements designed to protect policyholders and maintain market stability. Another incorrect approach that prioritizes market share growth through aggressive, unsustainable pricing without a thorough understanding of the underlying risk profile is also professionally unacceptable. This can lead to a race to the bottom in pricing, where insurers compete by offering inadequate premiums, ultimately harming the industry's reputation and potentially leading to insolvencies. This disregards the fundamental actuarial responsibility to price risks appropriately and sustainably. A third incorrect approach that ignores the potential impact on customer loyalty and the long-term value of policyholder relationships by implementing a price reduction that is not actuarially justified by a reduction in risk or expense is also flawed. While customer satisfaction is important, pricing decisions must be grounded in sound actuarial principles and risk assessment. Making pricing decisions based purely on perceived market demand without actuarial validation can lead to unintended financial consequences and regulatory scrutiny. The professional decision-making process for similar situations involves a structured approach. 1. Understand the objective. Clearly define the business goal, e.g., cost reduction, market share increase. 2. Identify all relevant factors. Consider financial, operational, market regulatory, and ethical implications. 3. Apply actuarial principles. Ensure that any proposed action is consistent with sound actuarial practice, including risk assessment, pricing adequacy, and reserving. 4. Consult relevant regulations and standards. Verify compliance with all applicable laws, regulations, and professional guidelines. 5. Evaluate alternatives. Assess different courses of action, weighing their respective benefits and drawbacks. 6. Document the decision-making process. Maintain clear records of the analysis, assumptions, and rationale behind the final recommendation. 7. Communicate findings and recommendations. Clearly articulate the implications of the proposed action to relevant stakeholders. Question 3. Assessment of a new insurance product designed to cover potential losses arising from cyber attacks on small businesses. The insurer anticipates that the frequency and severity of cyber attacks are likely to increase over time due to evolving technology and sophisticated threat actors. Which classification best describes the primary nature of the risk being underwritten, considering both the potential for loss and its susceptibility to change? Option A, pure static risk. Option B, speculative static risk. Option C, speculative dynamic risk. Option D, pure dynamic risk. The correct answer is D, pure dynamic risk. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of risk classification within the specific regulatory framework governing insurance exams, which is assumed to be the UK regulatory framework for this context. Misclassifying risks can lead to inadequate risk management strategies, incorrect pricing, and ultimately, regulatory noncompliance. The challenge lies in applying the theoretical definitions of pure, speculative, static, and dynamic risks to a practical insurance context, ensuring alignment with regulatory expectations for solvency, capital adequacy, and consumer protection. The correct approach involves accurately identifying the nature of the risk based on its potential for loss or gain and its susceptibility to change over time, as defined by UK insurance regulations and relevant professional guidelines. This aligns with the regulatory requirement for insurers to maintain robust risk management systems that can identify, assess, and manage all material risks. Specifically, pure risks are those where there is only a possibility of loss or no loss, whereas speculative risks involve the possibility of gain or loss. Static risks are those that do not change significantly over time, while dynamic risks are subject to change. An insurer's ability to correctly categorize these risks is fundamental to developing appropriate underwriting, reserving, and capital allocation strategies, thereby fulfilling its duty of care and adhering to principles of sound financial management, as mandated by bodies like the Prudential Regulation Authority, PRA, and the Financial Conduct Authority, FCA. An incorrect approach would be to conflate pure and speculative risks. For instance, classifying a risk as speculative when it is purely a pure risk, e.g., fire damage to a property, would imply that the insurer could benefit from the event, which is contrary to the fundamental purpose of insurance and regulatory principles. This misclassification could lead to an underestimation of potential losses and an inappropriate pricing strategy, potentially exposing the insurer to solvency issues and failing to meet its obligations to policyholders, a direct contravention of regulatory requirements for financial stability. Another incorrect approach would be to treat all changing risks as dynamic without considering their impact on the insurer's core business. While many risks evolve, the regulatory focus is on those dynamic risks that materially affect the insurer's financial position or ability to meet its obligations. For example, a minor shift in consumer preferences that has a negligible impact on claims frequency might not be considered a material dynamic risk requiring significant strategic adjustment, whereas a systemic change in climate patterns affecting property insurance claims would be. Failing to differentiate the materiality of dynamic risks can lead to inefficient resource allocation and a failure to focus on the most significant threats, thereby not adhering to the spirit of proactive risk management expected by regulators. The professional decision-making process for similar situations should involve a systematic review of the risk against established definitions, considering the specific context of the insurance product and the insurer's operation. Professionals should consult relevant regulatory guidance and industry best practices to ensure accurate classification. When in doubt, seeking clarification from senior risk management personnel or compliance departments is crucial. The ultimate goal is to ensure that risk classification supports sound business decisions and robust regulatory compliance, safeguarding both the insurer and its policyholders. Question 4. Upon reviewing the current risk management framework, the internal audit team has identified that the qualitative risk assessment process relies heavily on the subjective interpretations of various department heads. While these individuals have extensive experience, there is no standardized methodology for defining the likelihood and impact scales, leading to inconsistent risk ratings across different business units. Which of the following approaches would best address this implementation challenge while adhering to regulatory expectations for a robust risk management system? Option A. Shift the focus of qualitative assessment to solely analyzing the frequency of past risk events within each department to identify recurring issues. Option B. Develop and implement a standardized risk matrix with clearly defined qualitative scales for likelihood and impact, accompanied by training for all personnel involved in risk assessment to ensure consistent application. Option C. Encourage department heads to continue using their own judgment, but require them to document their reasoning for each risk assessment to provide a basis for future review. Option D. Delegate the responsibility for qualitative risk assessment entirely to a dedicated risk management team, with minimal input from operational departments. Correct answer is B. Develop and implement a standardized risk matrix with clearly defined qualitative scales for likelihood and impact, accompanied by training for all personnel involved in risk assessment to ensure consistent application. Explanation: this scenario presents a professional challenge because implementing qualitative risk assessment effectively requires more than just identifying risks. It demands a nuanced understanding of how to translate subjective assessments into actionable insights within a regulated environment. The challenge lies in balancing the inherent subjectivity of qualitative methods with the need for objective, defensible risk management practices that comply with regulatory expectations. Careful judgment is required to ensure that the chosen approach is both practical for the organization and robust enough to meet supervisory standards. The correct approach involves a structured process for defining the likelihood and impact scales, ensuring these scales are clearly understood and consistently applied by all participants. This structured approach is crucial for achieving comparability and reliability in qualitative assessments, which is a key expectation for regulatory compliance. By establishing clear definitions and using a consistent framework, the organization can demonstrate to regulators that its risk assessments are systematic and not arbitrary. This aligns with the principle of sound risk management, which requires that risk identification and assessment processes be well documented and repeatable. An incorrect approach that relies solely on the intuitive judgment of senior management without a defined framework is professionally challenging because it lacks transparency and consistency. This can lead to biased assessments, where the perceived importance of a risk is influenced by individual opinions rather than objective criteria. Regulators often require evidence of a systematic approach to risk assessment, and relying purely on intuition makes it difficult to demonstrate this. Furthermore, this approach can lead to a failure to identify or adequately prioritize risks that might be less visible to senior management, but are still significant from a regulatory or operational perspective. Another incorrect approach that focuses exclusively on the frequency of past incidents without considering the potential impact of future, novel risks is also professionally unacceptable. While historical data is valuable, it may not capture emerging threats or the potential for low-frequency, high-impact events. A robust qualitative risk assessment must consider a broader spectrum of potential outcomes, including those that have not yet occurred. Failing to do so can result in a false sense of security and leave the organization vulnerable to unforeseen events, which is a direct contravention of the duty to manage risks comprehensively. The professional decision-making process for similar situations should involve a thorough understanding of the organization's risk appetite, the regulatory landscape, and the limitations of different risk assessment methodologies. It requires selecting and implementing qualitative assessment tools that are appropriate for the organization's complexity and risk profile, ensuring clear definitions for likelihood and impact, and establishing a process for regular review and validation of the assessments. Professionals should prioritize approaches that promote consistency, transparency, and demonstrability to regulators, while also ensuring that the assessment captures the full range of potential risks. Question 5. Compliance review shows that an insurer has increased premiums for a specific group of policyholders, citing an increased probability of claims due to localized environmental changes. However, The communication to policyholders focuses heavily on the increased probability of specific adverse events, without providing context on the overall risk reduction measures in place or historical claim data that might temper the perceived increase in risk. The compliance officer is concerned that this approach may be misleading. Which of the following approaches best addresses this concern while adhering to regulatory and ethical standards? Option A. Clearly explain the identified environmental factors contributing to the increased probability of claims, present relevant historical data that supports the actuarial assessment, and outline any risk mitigation strategies that have been considered or implemented. Option B. Provide a detailed explanation of the probabilistic models used, including all underlying assumptions and data sources, to demonstrate the scientific basis for the premium increase. Option C. Issue a general statement acknowledging that premium adjustments are a normal part of insurance and that the insurer operates within regulatory guidelines, without further elaboration on the specific reasons for this group's increase. Option D. Reframe the communication to emphasize the insurer's commitment to fair pricing based on risk, while offering a discount for policyholders who agree to waive certain coverage options. The correct answer is B. Provide a detailed explanation of the probabilistic models used, including all underlying assumptions and data sources, to demonstrate the scientific basis for the premium increase. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's financial interests with the ethical obligation to provide accurate and transparent information to policyholders. The use of probability analysis in underwriting and pricing is standard practice, but misrepresenting or selectively presenting this analysis to justify potentially unfair premium increases creates an ethical dilemma. The challenge lies in discerning when probability analysis is used as a legitimate risk management tool and when it is manipulated to serve other objectives, potentially at the expense of consumer trust and regulatory compliance. Careful judgment is required to ensure that probability analysis is applied ethically and transparently. The correct approach involves a commitment to transparency and fairness in communicating the rationale behind premium adjustments. This means clearly explaining how probability analysis, such as the increased likelihood of claims due to specific environmental factors, has informed the underwriting decisions and subsequent pricing. It requires presenting the data and the methodology in an understandable manner, without resorting to misleading simplifications or omissions. This approach aligns with regulatory expectations that insurers act in good faith and provide clear, accurate information to their customers. Ethically, it upholds the principle of honesty and respect for the policyholder. An incorrect approach would be to selectively highlight certain probabilistic factors while downplaying others that might mitigate the perceived risk, or to present complex probabilistic models in a way that obscures the true drivers of the premium increase. This could involve focusing solely on the increased probability of a specific event, without contextualizing it with historical claim data or the overall risk profile of the policyholder. Such an approach is ethically problematic as it misleads the policyholder and erodes trust. From a regulatory standpoint, it could be seen as a violation of disclosure requirements and potentially unfair or deceptive practices, depending on the specific regulations governing insurance communications. Another incorrect approach would be to dismiss the policyholder's concerns about the premium increase by simply stating that the decision is based on actuarial science without providing any meaningful explanation. This demonstrates a lack of empathy and a failure to engage with the customer's legitimate questions. Ethically, it is disrespectful and unhelpful. Regulatorily, it may not meet the standards for clear communication and customer service expected of insurance providers. The professional decision-making process in such situations should involve a commitment to understanding the policyholder's perspective, a thorough review of the probability analysis used, and a dedication to transparent and honest communication. Professionals should ask themselves if the explanation provided is clear, accurate, and complete, and if it would be understood and accepted by a reasonable policyholder. They should also consider whether the communication aligns with the insurer's ethical values and regulatory obligations. If there is any doubt, seeking clarification from actuarial or compliance departments is essential. Question 6. Performance analysis shows that a significant number of claims are being settled with unexpected outcomes, leading to increased loss ratios. An underwriter is reviewing a commercial property insurance policy for a manufacturing client. The declarations page lists the insured's primary business as light assembly. However, during a site visit, the underwriter observed machinery and processes indicative of medium-risk manufacturing activities. The policy also includes an endorsement that modifies the fire legal liability clause. Which of the following actions by the underwriter best upholds the contractual elements of the insurance policy and regulatory compliance? Option A. Immediately increase the premium significantly without further investigation, citing the observed discrepancy as a material change in risk. Option B. Advise the insured that the policy cannot be issued due to the discrepancy and cancel the application. Option C. Proceed with issuing the policy as is, assuming the declarations page accurately reflects the insured's risk profile and the endorsement is standard. Option D. Request clarification from the insured regarding their business operations and ensure the declarations page and any endorsements accurately reflect the assessed risk and agreed-upon terms before finalizing the policy. The correct answer is C. Proceed with issuing the policy as is, assuming the declarations page accurately reflects the insured's risk profile and the endorsement is standard. Explanation: this scenario is professionally challenging because it requires an insurance underwriter to balance the need to accurately assess risk with the contractual obligations and legal requirements of an insurance policy. Misinterpreting or overlooking key contractual elements can lead to significant financial and legal repercussions for both the insurer and the insured. The underwriter must exercise careful judgment to ensure the policy accurately reflects the risk and complies with all applicable regulations. The correct approach involves a thorough review of the policy's declarations page and the relevant policy conditions. This ensures that all agreed-upon terms, conditions, exclusions, and endorsements are correctly documented and understood by both parties, specifically verifying that the insured's stated business operations align with the underwriter's assessment of risk, and that any endorsements accurately modify the standard policy terms to reflect unique circumstances, is crucial. This aligns with the fundamental principle of utmost good faith, uberrimi fidei, in insurance contracts, requiring full disclosure and accurate representation of material facts. Regulatory frameworks, such as those governing insurance contracts, mandate that policies clearly define the scope of coverage and any limitations, ensuring transparency and fairness to the policyholder. An incorrect approach would be to assume the declarations page is a mere formality and proceed without verifying its accuracy against the insured's actual operations. This fails to uphold the principle of utmost good faith and could lead to a policy that does not provide the intended coverage, potentially resulting in a claim being denied due to misrepresentation or non-disclosure of material facts. This also breaches regulatory requirements for clear and accurate policy documentation. Another incorrect approach is to rely solely on the insured's verbal assurances without cross-referencing them with the written policy documents and endorsements. Insurance contracts are legally binding documents, and verbal agreements or understandings that are not incorporated into the written policy are generally not enforceable. This disregard for the written contract undermines its legal standing and the regulatory expectation that policies are comprehensive and unambiguous. A third incorrect approach is to ignore the potential impact of endorsements on the overall coverage. Endorsements are integral parts of the policy and can significantly alter or restrict coverage. Failing to understand and account for these modifications means the underwriter is not accurately assessing the risk or ensuring the policy meets the insured's needs and regulatory compliance. This can lead to underpricing the risk or providing inadequate coverage, both of which are detrimental. The professional decision-making process for similar situations should involve a systematic review of all policy documentation, including the declarations page, the main policy wording, and all endorsements. This should be followed by a verification process to ensure the written terms accurately reflect the assessed risk and the insured's stated circumstances. If discrepancies arise, the underwriter must engage with the insured to clarify and rectify them before issuing the policy, ensuring compliance with contractual obligations and regulatory standards. Question 7. Implementation of a new claims management system is being considered to optimize processes related to loss frequency and severity. Which of the following approaches best aligns with regulatory expectations for effective risk management in insurance? Option A. Rolling out the new system with minimal training for claims adjusters, relying on their existing experience to adapt to the new technology and manage claims effectively. Option B. Prioritizing system features that aggressively reduce the average payout per claim, with the expectation that this will automatically control overall loss severity without further analysis. Option C. Conducting a comprehensive analysis of historical claims data to identify patterns in loss frequency and severity, using these insights to tailor system functionalities and workflow adjustments that specifically address identified risk drivers. Option D. Implementing the new system with a primary focus on automating data entry and reducing manual processing times, assuming this will inherently improve loss frequency and severity management. The correct answer is D. Implementing the new system with a primary focus on automating data entry and reducing manual processing times, assuming this will inherently improve loss frequency and severity management. Explanation. This scenario presents a professional challenge because optimizing processes for loss frequency and severity requires a nuanced understanding of both statistical patterns and the practical implications of risk mitigation strategies within the specific regulatory environment. The challenge lies in balancing the drive for efficiency with the imperative to maintain robust risk management practices that comply with regulatory expectations and protect policyholders. Careful judgment is required to ensure that process changes do not inadvertently weaken controls or lead to unintended consequences that could increase overall risk exposure. The correct approach involves a systematic review of existing claims handling and underwriting processes, identifying areas where data analytics can inform more accurate loss frequency and severity predictions, and then implementing targeted improvements. This includes leveraging technology to automate data collection and analysis, refining underwriting guidelines based on emerging trends, and developing proactive claims management strategies. This approach is professionally sound and aligns with regulatory expectations for prudent risk management, which mandates that insurers actively manage their risks, including those related to the frequency and severity of claims, to ensure solvency and fair treatment of policyholders. Regulators expect insurers to demonstrate a proactive and data-driven approach to risk mitigation. An incorrect approach would be to implement broad, unverified changes to claims handling procedures solely based on anecdotal evidence or a desire for cost reduction, without a thorough data analysis of loss frequency and severity trends. This could lead to inadequate claims payouts or increased operational inefficiencies, potentially violating regulatory requirements for fair claims settlement and solvency. Another incorrect approach would be to focus exclusively on reducing claims severity without considering the potential impact on loss frequency, or vice versa. This unbalanced focus fails to address the holistic nature of risk management and could lead to unintended consequences, such as increased claim numbers if severity mitigation measures are too restrictive, or higher overall payouts if frequency is not adequately controlled. Such an approach would likely fall short of regulatory expectations for comprehensive risk management. Professionals should employ a decision-making framework that prioritizes data-driven insights, regulatory compliance, and a balanced consideration of both loss frequency and severity. This involves establishing clear objectives for process optimization, conducting thorough risk assessments of proposed changes, and implementing pilot programs to evaluate effectiveness before full rollout. Continuous monitoring and evaluation of key risk indicators are essential to ensure that implemented processes remain effective and compliant. Question 8. Which approach would be most appropriate for an insurance professional who, while reviewing a client's policy, discovers information suggesting the client may be planning to engage in an activity that could cause significant harm to a third party, and the professional is bound by strict client confidentiality rules? Option A. Ignore the information to maintain strict client confidentiality. Option B. Seek guidance from the insurer's legal and compliance departments before taking any action. Option C. Immediately disclose the information to the potential third party to prevent harm. Option D. Discuss the information with other insurance professionals not directly involved in the client's account. The correct answer is C. Immediately disclose the information to the potential third party to prevent harm. Explanation. This scenario presents a professional challenge because it pits the duty of client confidentiality against the potential for harm to a third party, requiring a delicate balance of legal obligations and ethical considerations within the insurance regulatory framework. The insurance professional must navigate the complexities of data privacy laws and professional conduct guidelines. The correct approach involves seeking guidance from the insurer's legal and compliance departments. This is the most appropriate course of action because it ensures that any disclosure of information is made in strict accordance with the relevant regulatory framework, which prioritizes client confidentiality, but also outlines specific exceptions where disclosure may be permissible or even mandatory to prevent harm. By involving legal and compliance, the professional ensures that the decision is not made in isolation, but is informed by expert interpretation of the law and company policy, thereby mitigating personal and organizational liability. This aligns with the principle of acting with integrity and due diligence, as mandated by professional standards and insurance regulations. An incorrect approach would be to directly disclose the information to the third party without authorization. This would violate the fundamental principle of client confidentiality, a cornerstone of insurance practice and a legally protected right. Such a breach could lead to severe regulatory penalties, including fines and disciplinary action, as well as potential civil litigation from the client. Another incorrect approach would be to ignore the information and take no action. While this might seem like a way to avoid breaching confidentiality, it could be construed as negligence if the information clearly indicates an imminent threat that the insurer has a duty to address or report under specific legal provisions. This failure to act could also have serious ethical and legal repercussions if harm subsequently occurs. A further incorrect approach would be to disclose the information to colleagues within the company who are not involved in the client's case or do not have a legitimate need to know. This constitutes an unauthorized internal disclosure, which also breaches client confidentiality and can undermine trust within the organization and with clients. The professional decision-making process for similar situations should involve a structured approach. First, identify the ethical and legal obligations at play, particularly regarding confidentiality and potential harm. Second, consult internal policies and procedures. Third, seek advice from the designated legal and compliance experts within the organization. Fourth, document all consultations and decisions made. This systematic process ensures that actions are taken within the bounds of the law and ethical standards, protecting both the client and the professional. Question 9. The analysis reveals that an insurance company is handling a complex liability claim where the extent of damage is disputed. The company is considering engaging an independent loss adjuster to provide an expert opinion on the quantum of the claim. However, the claims manager is aware of a particular loss adjuster who has a reputation for providing conservative estimates that often align with the insurer's desired settlement range. The claims manager is contemplating instructing this specific loss adjuster, believing it will streamline the claims process and potentially reduce the payout. Which of the following approaches best upholds the principles of risk management and regulatory compliance in this scenario? Option A. Engage the loss adjuster known for conservative estimates and subtly guide their assessment towards a lower valuation by highlighting specific aspects of the policy that might limit coverage. Option B. Instruct the loss adjuster known for conservative estimates, as their consistent approach will provide a predictable outcome and potentially lower the claim cost, which is a key risk mitigation strategy. Option C. Instruct the loss adjuster known for conservative estimates, and if their initial assessment is still higher than anticipated, request they revise their report to reflect a more favorable outcome for the insurer. Option D. Engage an independent loss adjuster with a proven track record of objective and thorough assessments, regardless of their typical settlement range, and instruct them to provide an unbiased opinion based on all available evidence. Correct answer is D. Engage an independent loss adjuster with a proven track record of objective and thorough assessments, regardless of their typical settlement range, and instruct them to provide an unbiased opinion based on all available evidence. Explanation: this scenario presents a professional challenge due to the inherent conflict between the insurer's desire for a favorable outcome and the duty to act with integrity and fairness when relying on expert opinions. The complexity arises from the potential for bias, whether intentional or unintentional, to influence the expert's assessment, which in turn can impact claims settlements and regulatory compliance. Careful judgment is required to ensure that the expert's opinion is sought and used in a manner that upholds ethical standards and regulatory requirements. The correct approach involves engaging an independent expert whose qualifications are thoroughly vetted and whose report is reviewed for objectivity and completeness. This expert should be instructed to provide an unbiased assessment based on their professional knowledge and the available evidence. The insurer must then consider this opinion in good faith, without attempting to unduly influence the outcome. This aligns with the principles of fair dealing and the regulatory expectation that insurers act with integrity in their dealings with policyholders and in the management of claims. Specifically, under the regulatory framework for this exam, insurers have a duty to treat customers fairly, which includes ensuring that claims are assessed impartially and that expert opinions are not manipulated to the detriment of the policyholder. An incorrect approach would be to select an expert known for consistently providing opinions favorable to the insurer, even if their technical qualifications are sound. This raises concerns about apparent bias and could be seen as an attempt to circumvent the spirit of fair claims handling, potentially violating regulatory expectations regarding impartiality. Another incorrect approach would be to pressure the expert to revise their opinion if it is not favorable to the insurer. This directly undermines the independence of the expert and constitutes a failure to act with integrity. Such actions could lead to regulatory sanctions for unfair claims practices and a breach of professional conduct. A further incorrect approach would be to disregard an expert opinion that is unfavorable to the insurer without a valid documented reason. This demonstrates a lack of good faith in the claims process and a failure to properly consider all relevant evidence, which is contrary to regulatory requirements for fair and thorough claims investigation. Professionals should adopt a decision-making process that prioritizes objectivity and integrity. This involves clearly defining the scope of the expert's engagement, ensuring their independence, critically reviewing their findings, and documenting all decisions made in relation to the expert's opinion. When faced with an unfavorable opinion, the process should involve seeking clarification, requesting further information if necessary, and making a reasoned decision based on all available evidence, rather than simply dismissing it. Question 10. Market research demonstrates that effective risk management in the insurance sector requires a deep understanding of an insurer's operational efficiency. When analyzing an insurer's financial statements to assess the effectiveness of its process optimization efforts, which of the following approaches provides the most insightful and regulatorily compliant evaluation? Option A. Primarily analyzing the insurer's current ratio and quick ratio to assess short-term liquidity. Option B. Analyzing the trend of operating expenses relative to premium income over multiple financial periods. Option C. Exclusively examining the year-over-year growth rate of the insurer's total assets. Option D. Focusing solely on the absolute value of the net profit margin in the most recent financial year. The correct answer is B. Analyzing the trend of operating expenses relative to premium income over multiple financial periods. Explanation: scenario analysis. This scenario presents a professional challenge for an insurance risk manager because it requires them to interpret financial statements not just for their face value, but to infer underlying operational efficiency and potential future risks. The challenge lies in moving beyond simple ratio calculations to a qualitative assessment of process optimization, which is crucial for proactive risk management and ensuring the insurer's long-term solvency and market competitiveness. Regulatory frameworks, such as those governing solvency and financial reporting for insurers, mandate that risk managers demonstrate a thorough understanding of the business's financial health and operational effectiveness. Correct approach analysis. The correct approach involves analyzing the trend of operating expenses relative to premium income over several periods. This method is correct because it directly assesses the efficiency of the insurer's core operations. A declining trend in this ratio, or a stable trend with increasing premium income, suggests effective cost management and process optimization. This aligns with regulatory expectations that insurers operate efficiently to maintain solvency and provide value to policyholders. Such an analysis provides insights into whether the insurer is effectively controlling its underwriting and administrative costs, which are key drivers of profitability and risk. Incorrect approaches analysis. One incorrect approach is to focus solely on the absolute value of net profit margin without considering its trend or the underlying operational drivers. While a high net profit margin is desirable, it can be artificially inflated by one-off gains or unsustainable underwriting practices, masking underlying inefficiencies in core operations. This approach fails to meet the regulatory requirement for a deep dive into operational risk and process effectiveness. Another incorrect approach is to exclusively examine the growth rate of total assets. While asset growth can indicate business expansion, it does not inherently reflect process optimization. Rapid asset growth funded by inefficient operations or excessive leverage could actually signal increased financial risk, not improved efficiency. Regulators expect risk managers to identify the drivers of financial performance, not just the headline growth figures. A third incorrect approach is to solely analyze the liquidity ratios, such as the current ratio. While liquidity is vital for an insurer's short-term obligations, it does not directly measure the efficiency of its core insurance operations or its ability to manage underwriting and administrative processes effectively. Focusing only on liquidity overlooks the operational risks that can impact long-term financial stability, a key concern for regulatory oversight. Professional reasoning. Professionals should adopt a holistic approach to financial statement analysis, integrating quantitative data with qualitative insights into operational processes. This involves looking beyond single metrics to understand trends, interrelationships between financial items, and the underlying business activities. When assessing process optimization, the focus should be on metrics that directly reflect operational efficiency, such as expense ratios relative to revenue, and the trend of these metrics over time. This proactive and analytical approach ensures compliance with regulatory mandates for robust risk management and fosters sound business decision-making. Question 11. Quality control measures reveal that the insurance company's risk management framework has not been comprehensively reviewed for significant emerging risks in the past 18 months, despite a recent increase in market volatility and a new regulatory directive impacting solvency requirements. Which of the following approaches best addresses this situation to ensure ongoing compliance and effective risk oversight? Option A. Initiate a targeted review of the most recent internal audit findings and update existing risk registers based on those recommendations. Option B. Delegate the responsibility for monitoring emerging risks to individual department heads without a centralized oversight mechanism. Option C. Conduct a full-scale, risk-based review of the entire risk management framework, including an assessment of new and emerging risks, the impact of the regulatory directive, and the effectiveness of current controls in the volatile market environment. Option D. Increase the frequency of reporting on operational risks, as these are typically the most immediate concerns for policyholders. Correct answer is A. Initiate a targeted review of the most recent internal audit findings and update existing risk registers based on those recommendations. Explanation. This scenario is professionally challenging because it requires balancing the need for ongoing risk oversight with the practical constraints of resource allocation and the potential for information overload. The designated risk manager must exercise careful judgment to ensure that monitoring and review processes remain effective and proportionate to the identified risks, without becoming overly burdensome or superficial. The challenge lies in identifying the most critical areas for review and ensuring that the insights gained are actionable and contribute to the overall risk management framework. The correct approach involves a systematic and risk-based review of the insurance company's risk management framework. This entails regularly assessing the effectiveness of existing controls, identifying emerging risks, and evaluating the adequacy of risk mitigation strategies. This approach aligns with the principles of sound risk management, which mandate continuous monitoring and adaptation. Specifically, regulatory frameworks for insurance companies, such as those overseen by the Prudential Regulation Authority, PRA in the UK, emphasize the importance of a robust and dynamic risk management system. This includes regular reporting to senior management and the board on the risk profile and the effectiveness of risk mitigation measures. The goal is to ensure that the company remains solvent and protects policyholders, which necessitates a proactive and vigilant approach to risk. An incorrect approach would be to solely rely on the frequency of internal audit reports, without considering the dynamic nature of the risk landscape. Internal audits provide valuable assurance, but they are typically backward-looking and may not capture the most current or emerging risks. Over-reliance on this alone can lead to a false sense of security, as it might miss risks that have materialized since the last audit. This fails to meet the regulatory expectation for ongoing and forward-looking risk assessment. Another incorrect approach is to focus only on the most visible or frequently discussed risks, neglecting less obvious but potentially significant threats. This selective monitoring can create blind spots in the risk management framework. Regulatory expectations require a comprehensive view of the risk profile, encompassing all material risks, not just those that are easily identifiable or politically expedient to address. A third incorrect approach would be to conduct reviews without a clear methodology or defined objectives, leading to ad hoc and potentially ineffective assessments. This lack of structure means that critical risk areas might be overlooked, and the review process may not yield actionable insights. Effective monitoring and review require a structured process that is aligned with the company's strategic objectives and risk appetite. The professional decision-making process for similar situations should involve 1. Understanding the company's risk appetite and tolerance levels. 2. Identifying key risk indicators, CRI, that signal potential issues. 3. Establishing a clear review schedule and methodology, prioritizing areas based on risk severity and likelihood. 4. Ensuring that review findings are communicated effectively to relevant stakeholders, including senior management and the board, with clear recommendations for action. 5. Regularly updating the risk management framework and review processes in response to changes in the internal and external environment. Question 12. Compliance review shows that an insurance firm's business continuity planning process is heavily influenced by the perceived ease of implementing recovery solutions for different business units, with less emphasis placed on quantifying the actual impact of a disruption to those units. Which approach to impact assessment best aligns with regulatory expectations for operational resilience? Option A. Prioritizing recovery solutions based on the lowest implementation cost and shortest deployment time, regardless of the criticality of the business process. Option B. Conducting a comprehensive business impact analysis, BIA, to quantify financial, operational, reputational, and regulatory consequences of disruptions to critical business processes, and establishing recovery time and point objectives based on these impacts. Option C. Focusing recovery planning efforts primarily on business processes that have experienced disruptions in the past, assuming these are the most critical. Option D. Allocating resources to business units that are most vocal about their potential risks, even if a formal impact assessment has not been completed for those units. Correct answer is B. Conducting a comprehensive business impact analysis, BIA, to quantify financial, operational, reputational, and regulatory consequences of disruptions to critical business processes, and establishing recovery time and point objectives based on these impacts. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how to prioritize business continuity efforts based on their potential impact, rather than solely on the ease of implementation or the perceived likelihood of an event. The challenge lies in moving beyond superficial assessments to a deep, data-driven evaluation of criticality. Careful judgment is required to ensure that resources are allocated effectively to protect the most vital functions of the insurance business, thereby safeguarding policyholder interests and maintaining market stability. The correct approach involves conducting a thorough business impact analysis, BIA, that quantifies the financial, operational, reputational, and regulatory consequences of disruptions to critical business processes. This analysis should identify the maximum tolerable downtime for each process and the recovery time objectives, RTO, and recovery point objectives, RPO, necessary to meet these tolerances. This aligns with regulatory expectations, such as those found in the UK's Prudential Regulation Authority, PRA, and Financial Conduct Authority, FCA frameworks, which mandate robust operational resilience and business continuity planning. These regulations emphasize the need for firms to understand their critical functions and to have plans in place to prevent, respond to, recover from, and resolve disruptions. A BIA is the foundational step in achieving this. An incorrect approach that focuses solely on the ease of implementing recovery solutions fails to address the core regulatory requirement of ensuring operational resilience for critical functions. It prioritizes convenience over effectiveness, potentially leaving the firm vulnerable to significant losses if a disruption impacts a less easily recovered but highly critical process. This could lead to regulatory breaches related to inadequate risk management and failure to to protect policyholder interests. Another incorrect approach that prioritizes the likelihood of an event over its potential impact is also professionally unacceptable. While likelihood is a component of risk assessment, business continuity planning, particularly under operational resilience frameworks, is fundamentally about managing the consequences of disruptions. Focusing only on low-likelihood events, even if they are easy to plan for, means that high-impact, albeit less likely, events might not receive adequate attention, leaving the firm exposed to catastrophic failure. This neglects the principle of ensuring continuity for all critical functions, regardless of their perceived probability of disruption. A third incorrect approach that relies on anecdotal evidence or past experiences without a structured impact assessment is also flawed. While historical data can inform risk assessment, it is not a substitute for a systematic BIA. Anecdotal evidence can be subjective and may not capture the full spectrum of potential impacts or the interconnectedness of business processes. This lack of a structured, data-driven approach can lead to an incomplete understanding of vulnerabilities and an inadequate business continuity plan, potentially violating regulatory requirements for comprehensive risk management. The professional decision-making process for similar situations should involve a structured, risk-based methodology. This begins with identifying all critical business processes and their dependencies. Subsequently, a comprehensive BIA should be performed to understand the potential impacts of disruptions. Based on the BIA findings, recovery strategies and plans can be developed and prioritized, ensuring that the most critical functions have the shortest RTOs and RPOs. Regular testing, review, and updating of these plans are essential to maintain their effectiveness and ensure ongoing compliance with regulatory expectations for operational resilience. Question 13. Benchmark analysis indicates that insurers are increasingly facing novel and evolving risks. In the context of identifying potential perils for a commercial property insurance policy, which of the following approaches best aligns with robust risk management principles and regulatory expectations for comprehensive peril identification? Option A. Primarily reviewing the insured's historical claims data for the past 5 years to identify recurring loss events. Option B. Relying on a standardized peril checklist provided by an industry association without further customization. Option C. Conducting a thorough review of the insured's operations, industry-specific emerging risks, and relevant geopolitical and environmental factors. Option D. Focusing solely on perils that have historically resulted in the highest frequency of claims, irrespective of their potential severity. The correct answer is A. Primarily reviewing the insured's historical claims data for the past 5 years to identify recurring loss events. Explanation. Scenario analysis. This scenario presents a professional challenge because identifying perils in insurance risk management requires a systematic and comprehensive approach. Failure to identify all relevant perils can lead to underpricing, inadequate reserves, and ultimately, financial instability for the insurer, impacting policyholders and the market. The challenge lies in moving beyond obvious threats to uncover less apparent but potentially significant risks, requiring a deep understanding of the insured's operations and the external environment. Professional judgment is crucial in determining the scope and depth of the peril identification process. Correct approach analysis. The correct approach involves a multifaceted peril identification strategy that combines internal data analysis with external environmental scanning. This includes reviewing historical claims data to understand past losses, analyzing policy wording to identify coverage gaps or ambiguities, and conducting thorough site inspections or operational reviews to understand the insured's specific exposures. Crucially, it also involves researching industry trends, regulatory changes, and macroeconomic factors that could introduce new or amplify existing perils. This comprehensive method aligns with the principles of prudent risk management expected by regulatory bodies, such as the Prudential Regulation Authority, PRA in the UK, which emphasizes a robust understanding of all material risks faced by an insurer. Ethically, it ensures that the insurer is adequately prepared to meet its obligations to policyholders. Incorrect approach is analysis. Relying solely on readily available historical claims data without considering emerging trends or external factors is an insufficient approach. This fails to account for new perils or changes in the frequency or severity of existing ones, potentially leading to underestimation of risk and inadequate pricing. This approach risks violating regulatory expectations for forward-looking risk assessment. Focusing exclusively on the most frequent perils identified in past claims data, while ignoring less frequent but potentially catastrophic events, is also a flawed strategy. This overlooks the potential for low-probability, high-impact perils that can significantly disrupt an insurer's financial stability. Regulatory frameworks often require consideration of tail risk and systemic threats. Adopting a checklist-based approach that only considers perils explicitly listed in standard industry templates, without tailoring it to the specific insured's unique circumstances and operating environment, is another inadequate method. This can lead to overlooking specific, idiosyncratic perils that are highly relevant to the insured but not captured by generic checklists. This demonstrates a lack of due diligence and a failure to apply professional judgment to the specific risk profile. Professional reasoning. Professionals should employ a structured decision-making framework for peril identification. This begins with defining the scope of the review based on the type of insurance and the complexity of the insured's operations. Next, a combination of quantitative, historical data analysis and qualitative interviews, site visits, expert consultation methods should be used to gather information. This information should then be synthesized to identify potential perils, categorizing them by likelihood and impact. Finally, a review process involving senior risk managers and underwriting teams should validate the identified perils and ensure that the identification process has been thorough and has considered all relevant internal and external factors. This iterative process ensures a robust and defensible peril identification strategy. Question 14. Consider a scenario where a commercial property insurance policyholder reports significant water damage to their inventory. The policyholder describes the damage as occurring when a severe storm caused a nearby river to overflow, inundating their warehouse. However, the policy's definition of flood specifically excludes damage caused by surface water, overflow of streams or other bodies of water, or tidal waves. Underwriter suspects the damage may have been caused by a burst internal pipe exacerbated by the storm's heavy rainfall, which would be covered under a different policy endorsement. The policyholder is a long-standing and valuable client. What is the most appropriate course of action for the underwriter? Option A. Approve the claim immediately based on the policyholder's description of water damage, given their long-standing relationship and the severity of the loss. Option B. Conduct a thorough investigation into the precise cause of the water damage, comparing the findings against the policy's definitions of flood and other relevant coverage provisions, and communicate the findings transparently to the policyholder. Option C. Advise the policyholder that the policy does not cover flood damage and suggest they explore alternative insurance options for future events. Option D. Deny the claim outright, citing the policy exclusion for flood damage as described by the client. The correct answer is A. Approve the claim immediately based on the policyholder's description of water damage, given their long-standing relationship and the severity of the loss. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desire and the insurer's contractual obligations, compounded by the potential for misinterpretation of policy language. The underwriter must navigate this ethical tightrope, balancing client relationships with adherence to policy terms and regulatory requirements. A failure to do so could lead to reputational damage, regulatory sanctions, and financial loss for the insurer. The correct approach involves a thorough review of the policy wording, specifically the definitions of flood and water damage, and an objective assessment of the cause of loss against these definitions. This aligns with the fundamental principles of insurance contract law, which dictate that coverage is determined by the explicit terms and conditions of the policy. The insurer has a duty to act in good faith and fair dealing, which includes interpreting the policy as written and not creating coverage where none exists. This approach upholds the integrity of the insurance contract and ensures equitable treatment of all policyholders by adhering to the agreed-upon terms. An incorrect approach of immediately approving the claim based on the client's description, without verifying the cause of loss against the policy, would be a failure to adhere to the contractual agreement. This could lead to paying claims that are not covered, setting a precedent for future claims, and potentially violating the principle of utmost good faith by misrepresenting the scope of coverage. Another incorrect approach of denying the claim outright without a detailed investigation into the cause of loss, even if the initial description suggests it might be excluded, would also be a failure of good faith. The insurer has an obligation to investigate claims thoroughly and fairly. A hasty denial, especially if the cause of loss could arguably fall within an ambiguous policy term, could be seen as a breach of the duty to investigate and settle claims fairly. Finally, an incorrect approach of attempting to renegotiate the policy terms retroactively to cover the loss would be a serious ethical and regulatory breach. Insurance policies are contracts that are agreed upon at inception. Retroactively altering terms to accommodate a specific claim undermines the stability and predictability of the insurance market and is a violation of regulatory principles that govern contract sanctity. The professional decision-making process should involve 1. Acknowledging the client's situation and expressing empathy. 2. Initiating a prompt and thorough investigation into the cause of loss. 3. Carefully reviewing the relevant policy provisions, including definitions and exclusions. 4. Consulting with legal counsel or claims specialists if policy interpretation is complex or ambiguous. 5. Communicating the decision clearly and transparently to the client, explaining the rationale based on the policy terms and investigation findings. Question 15. The evaluation methodology shows that a risk manager is advising a client who has just purchased a new retail store building. The client wants to ensure the building and its contents are protected from damage, and that the business is covered if a customer is injured on the premises. The risk manager needs to determine the most appropriate type of insurance policy to recommend. Option A. Recommend a general liability insurance policy. Option B. Recommend a life insurance policy. Option C. Recommend a health insurance policy. Option D. Recommend a commercial property insurance policy that includes liability coverage. The correct answer is D. Recommend a commercial property insurance policy that includes liability coverage. Explanation. The evaluation methodology shows that a risk manager is presented with a scenario involving a client seeking advice on insurance coverage for a newly acquired commercial property. The challenge lies in accurately identifying the most appropriate type of insurance policy to mitigate the diverse risks associated with such an asset, considering potential perils like fire, theft, and liability claims. This requires a thorough understanding of the distinctions between various insurance policy types and their respective coverage scopes, as well as the ability to translate the client's specific needs and the property's characteristics into appropriate risk management solutions. The correct approach involves a comprehensive assessment of the property's potential risks and the client's specific needs, leading to the recommendation of a commercial property insurance policy. This policy is designed to cover direct physical loss or damage to the building and its contents from a wide range of perils, as well as provide liability coverage for incidents occurring on the premises. This aligns with the fundamental purpose of insurance as outlined in regulatory frameworks, which is to provide financial protection against specified losses. Specifically, under typical insurance regulations, commercial property insurance is the standard and most direct mechanism for insuring physical assets and associated liabilities of a business. An incorrect approach would be to recommend a general liability policy as the primary coverage. While general liability insurance covers third-party bodily injury and property damage claims arising from business operations, it does not typically cover direct physical damage to the insured's own property. This would leave the client exposed to significant financial losses from events like a fire or natural disaster damaging the building itself. This fails to meet the core requirement of protecting the insured's physical assets, a fundamental principle of property insurance. Another incorrect approach would be to suggest a life insurance policy. Life insurance provides a death benefit to beneficiaries upon the insured's passing and is entirely unrelated to the protection of physical property or business operations. Recommending this would demonstrate a severe misunderstanding of insurance product classifications and a failure to address the client's stated need for property protection, constituting a significant ethical and professional lapse. A further incorrect approach would be to recommend a health insurance policy. Health insurance covers medical expenses for individuals and has no relevance to insuring commercial property against physical damage or liability risks. This recommendation would be fundamentally misguided and would expose the client to substantial uninsured risks, violating professional duty of care and regulatory expectations for competent advice. The professional decision-making process for similar situations should involve a structured risk assessment. This begins with understanding the client's objectives and the nature of the asset or activity to be insured. Next, the risk manager must identify potential perils and liabilities specific to the situation. This knowledge is then used to match these risks with the most appropriate insurance policy types, considering their coverage limitations and exclusions. Finally, the recommended solution must be clearly communicated to the client, explaining why it is the most suitable option for their specific circumstances, ensuring compliance with regulatory requirements for suitability and disclosure. Question 16. The control framework reveals that following a significant property damage claim settlement where a third party was clearly identified as the sole cause of the loss, the claims department is considering not pursuing subrogation due to the perceived administrative burden and the relatively small amount of the potential recovery. What is the most appropriate course of action for the insurer? Option A. Abandon the subrogation effort entirely, as the administrative cost outweighs the potential recovery, and focus resources on other claims. Option B. Initiate subrogation proceedings against the identified third party to recover the settled claim amount, ensuring the policyholder is kept informed of the process. Option C. Delay the decision on subrogation until a later date, pending further review of the claim file and potential recovery prospects. Option D. Inform the policyholder that the insurer will not pursue subrogation and that the policyholder is free to pursue their own recovery efforts. The correct answer is B. Initiate subrogation proceedings against the identified third party to recover the settled claim amount, ensuring the policyholder is kept informed of the process. Explanation. The control framework reveals a common challenge in insurance operations, effectively managing subrogation rights. This scenario is professionally challenging because it requires balancing the insurer's right to recover losses from a responsible third party with the policyholder's potential need for prompt settlement and the complexities of legal recovery. Mismanagement can lead to financial losses for the insurer, dissatisfaction for the policyholder, and potential regulatory scrutiny. Careful judgment is required to navigate the legal and ethical considerations inherent in subrogation. The correct approach involves diligently pursuing subrogation when a clear third-party liability exists, while also ensuring that the policyholder is not prejudiced by this process. This means initiating subrogation efforts promptly after a claim is settled, gathering all necessary evidence, and communicating effectively with the policyholder about the process and potential outcomes. This aligns with the regulatory expectation that insurers act in good faith and exercise due diligence in managing their assets, which includes recovering funds through subrogation where appropriate. Ethically, it ensures that the burden of the loss is ultimately borne by the responsible party, not the insurer or the policyholder. An incorrect approach of abandoning subrogation solely due to the administrative effort involved would be professionally unacceptable. This failure would contravene the insurer's fiduciary duty to its policyholders and shareholders to minimize losses and recover funds where legally entitled. It could also be seen as a breach of good faith if the insurer fails to pursue a valid recovery avenue, potentially impacting future premium calculations or solvency. Another incorrect approach of pursuing subrogation aggressively without considering the policyholder's ongoing relationship or potential for undue stress would also be professionally unsound. This could lead to a breakdown in customer trust and potentially violate regulations regarding fair claims handling and customer service. The insurer must balance its recovery interests with its obligations to the policyholder. A third incorrect approach of delaying subrogation indefinitely without a clear strategy or justification would be a failure in operational efficiency and risk management. This could result in the loss of recovery opportunities due to statutes of limitations or the dissipation of evidence, ultimately harming the insurer's financial position and potentially leading to regulatory sanctions for poor claims management. Professionals should employ a decision-making framework that prioritizes clear policy guidelines for subrogation, thorough investigation of third-party liability, prompt action upon claim settlement, and transparent communication with policyholders. This framework should also include regular review of subrogation performance and adherence to all relevant legal and ethical standards. Question 17. Process analysis reveals that an insurance company's risk management department is evaluating different methodologies for identifying potential risks. Which of the following approaches best aligns with current best practices for comprehensive risk identification in the insurance sector, considering the need for forward-looking analysis and regulatory compliance? Option A. Relying on external audit reports to highlight any previously identified control weaknesses and associated risks. Option B. Analyzing historical claims data and past loss events to identify recurring patterns and their frequency. Option C. Conducting a comprehensive review of emerging technological trends, geopolitical developments, and evolving customer expectations to forecast potential future impacts on the business. Option D. Focusing exclusively on identifying and quantifying operational risks within the claims processing and underwriting departments. The correct answer is B. Analyzing historical claims data and past loss events to identify recurring patterns and their frequency. Explanation. This scenario presents a professional challenge because it requires an insurance risk manager to move beyond a superficial understanding of risk identification and engage in a systematic, forward-looking process that aligns with regulatory expectations for robust risk management. The challenge lies in ensuring that the chosen approach is not merely a reactive checklist, but a proactive and comprehensive method for uncovering potential risks that could impact the insurer's solvency, operational integrity, and customer trust. Careful judgment is required to select the method that best addresses the dynamic nature of the insurance business and the evolving regulatory landscape. The correct approach involves a structured, forward-looking analysis of potential future events and their impact on the insurer's operations and financial stability. This method is considered best professional practice because it aligns with the principles of prudential regulation, which mandate that insurers identify and manage risks effectively to protect policyholders and maintain financial soundness. Specifically, regulatory frameworks often require insurers to conduct scenario analysis and stress testing to understand their resilience to extreme but plausible events. This proactive identification of emerging risks, including those from new technologies, changing customer behaviors, or macroeconomic shifts, is crucial for developing appropriate mitigation strategies and capital planning. Such an approach demonstrates a commitment to forward-looking risk management, a key expectation for regulated entities. An incorrect approach that relies solely on historical data for risk identification fails to adequately address emerging risks. While historical data is valuable for understanding past patterns, it may not capture the unique characteristics of future risks, such as those arising from unprecedented technological advancements or novel cyber threats. This can lead to a false sense of security and leave the insurer vulnerable to unforeseen events. This approach is ethically and regulatorily deficient because it neglects the duty to anticipate and prepare for future uncertainties, potentially jeopardizing policyholder protection and the insurer's financial stability, which are core tenets of insurance regulation. Another incorrect approach that focuses only on operational risks, neglecting strategic and market risks, is also professionally unacceptable. Operational risks are important, but a comprehensive risk identification process must encompass all material risk categories. Strategic risks, such as those related to business model viability or competitive pressures, and market risks, including interest rate fluctuations or investment performance, can have a profound impact on an insurer's financial health. An insurer that ignores these broader categories is failing to conduct a holistic risk assessment, which is a fundamental requirement for effective risk management and is often explicitly or implicitly mandated by regulators concerned with the overall solvency and sustainability of the insurance entity. The professional decision-making process for similar situations should involve a systematic evaluation of various risk identification methodologies against the insurer's specific business model, strategic objectives, and the prevailing regulatory environment. Professionals should prioritize approaches that are forward-looking, comprehensive, and capable of identifying both known and emerging risks across all relevant risk categories. This involves consulting relevant regulatory guidance, industry best practices, and engaging in cross-functional discussions to ensure a thorough understanding of the risk landscape. The ultimate goal is to implement a risk identification process that provides actionable insights for risk mitigation and strategic decision-making, thereby fulfilling fiduciary duties and regulatory obligations. Question 18. The monitoring system demonstrates that several loss control programs have experienced a marginal increase in reported claims over the past 2 quarters. Which of the following approaches represents the most effective and compliant strategy for addressing this trend? Option A. Discontinue any loss control program that has shown any increase in claims, regardless of the magnitude or underlying reasons. Option B. Conduct a detailed analysis of the performance data for each affected loss control program to identify root causes and areas for targeted improvement before implementing changes. Option C. Rely on the qualitative feedback from loss control personnel to make immediate adjustments to program methodologies. Option D. Immediately increase the budget allocated to all loss control programs to bolster their effectiveness across the board. Correct answer is B. Conduct a detailed analysis of the performance data for each affected loss control program to identify root causes and areas for targeted improvement before implementing changes. Explanation. This scenario presents a professional challenge because it requires an insurer to balance the effectiveness of its loss control programs with the practicalities of implementation and the regulatory imperative to manage risks prudently. The challenge lies in identifying the most efficient and compliant method to enhance the impact of loss control initiatives, ensuring they not only reduce claims, but also meet the expectations of regulatory bodies regarding risk mitigation. Careful judgment is required to select an approach that is both operationally sound and legally defensible. The correct approach involves a systematic review and refinement of existing loss control programs based on performance data. This is the most professionally sound method because it directly addresses the core objective of loss control, to reduce the frequency and severity of claims. By analyzing the data, an insurer can identify which programs are underperforming, which are most effective, and where resources can be reallocated for maximum impact. This data-driven refinement aligns with regulatory expectations for prudent risk management, as it demonstrates a proactive and evidence-based approach to controlling potential losses. Regulatory frameworks often require insurers to maintain robust risk management systems, and a continuous improvement cycle based on performance metrics is a cornerstone of such systems. This approach ensures that loss control efforts are targeted, efficient, and demonstrably contributing to the insurer's financial stability and policyholder protection. An incorrect approach would be to simply increase the budget for all loss control programs without a clear understanding of their effectiveness. This is professionally unacceptable because it represents a potentially wasteful allocation of resources. Without data analysis, the insurer cannot be certain that additional funding will lead to improved outcomes. It fails to demonstrate a commitment to efficient risk management, and could be viewed by regulators as a superficial attempt at compliance rather than a genuine effort to mitigate risk. Another incorrect approach would be to discontinue loss control programs that show a slight increase in claims, without considering the broader context or potential for improvement. This is professionally unsound, as it may lead to the premature abandonment of potentially valuable initiatives. Claims can fluctuate for many reasons, and a short-term increase might not reflect a systemic failure of the program. Regulators expect insurers to investigate the root causes of claim trends and implement targeted solutions, not to react impulsively to isolated data points. Finally, an incorrect approach would be to rely solely on anecdotal evidence or the opinions of loss control staff to guide program changes. While staff expertise is valuable, it must be substantiated by objective data. Relying solely on subjective feedback bypasses the critical performance analysis required for effective risk management, and can lead to biased decision-making. This approach lacks the rigor expected by regulatory bodies and fails to provide a defensible basis for resource allocation or program modification. Professionals should adopt a decision-making framework that prioritizes data-driven analysis and continuous improvement. This involves establishing clear performance metrics for all loss control programs, regularly collecting and analyzing relevant data, and using these insights to inform strategic decisions about program design, resource allocation, and operational adjustments. This systematic process ensures that loss control efforts are aligned with business objectives and regulatory requirements, fostering a culture of proactive risk management. Question 19. The evaluation methodology shows that a new risk management framework is being implemented, and the impact assessment phase is crucial for understanding how identified risks could affect the insurer's strategic objectives and financial stability. Which approach to assessing the impact of risks best aligns with the principles of integrated enterprise risk management and regulatory expectations for insurers? Option A. An assessment that prioritizes the identification of operational risks and their potential to disrupt day-to-day business activities, with less emphasis on strategic or financial implications. Option B. a qualitative assessment based on expert judgment and anecdotal evidence, focusing on the reputational impact of potential risk events. Option C, a review of past claims data to identify trends and estimate potential future losses, focusing primarily on the financial impact of insurable events. Option D, a quantitative and qualitative assessment that considers the likelihood and magnitude of potential impacts on key performance indicators, capital adequacy, and solvency, incorporating both historical data and forward-looking scenario analysis. Correct answer is D, a quantitative and qualitative assessment that considers the likelihood and magnitude of potential impacts on key performance indicators, capital adequacy, and solvency, incorporating both historical data and forward-looking scenario analysis. Explanation: the evaluation methodology shows a critical juncture in integrating enterprise risk management into an insurer's core business processes. The professional challenge lies in ensuring that risk management is not a siloed function, but a pervasive element that informs strategic decisions, operational execution, and performance measurement. This requires a nuanced understanding of how different approaches to impact assessment can either embed effectively or relegate it to a compliance exercise. Careful judgment is required to select the methodology that best aligns with regulatory expectations for robust risk governance and promotes a proactive risk culture. The correct approach involves a comprehensive impact assessment that quantifies the potential effects of identified risks on key business objectives, capital adequacy, and solvency. This methodology necessitates a forward-looking perspective, considering both the likelihood and the magnitude of potential losses or opportunities. It directly supports regulatory requirements for insurers to understand and manage their risk exposures in a holistic manner, ensuring that risk appetite is translated into actionable controls and strategic planning. This approach fosters a culture where risk is considered in all significant business decisions, thereby enhancing resilience and long-term sustainability, which are paramount under regulatory frameworks focused on financial stability and consumer protection. An incorrect approach that focuses solely on historical loss data, without considering emerging risks or future scenarios, fails to meet regulatory expectations for forward-looking risk assessment. This can lead to underestimation of potential impacts and inadequate capital provisioning, creating a significant vulnerability. Another incorrect approach that prioritizes operational efficiency over risk mitigation overlooks the fundamental principle of which is to manage risks that could impede the achievement of business objectives. This can result in a disconnect between risk management activities and strategic goals, undermining the effectiveness of the framework. A third incorrect approach that treats risk impact assessment as a purely qualitative exercise, lacking quantitative rigor where appropriate, may not provide sufficient evidence for regulatory scrutiny or for informed decision-making regarding risk appetite and capital allocation. This can lead to subjective assessments that are difficult to defend and may not accurately reflect the true risk profile of the organization. Professionals should employ a decision-making framework that begins with a clear understanding of the insurer's strategic objectives and risk appetite. The chosen impact assessment methodology must then be evaluated against its ability to provide actionable insights that inform these objectives and align with the risk appetite. This involves considering the regulatory landscape, the specific nature of the insurer's business, and the availability of data and analytical capabilities. The process should be iterative, with regular reviews and updates to ensure the methodology remains relevant and effective in managing the evolving risk landscape. Question 20. The efficiency study reveals that the current qualitative risk assessment process within the insurance company is time-consuming and relies heavily on anecdotal evidence. To improve efficiency while maintaining regulatory compliance, management is considering several alternative approaches. Which of the following approaches best balances the need for a robust qualitative assessment with improved efficiency, ensuring adherence to regulatory expectations for understanding and managing potential threats? Option A. Implementing a structured qualitative risk assessment framework that utilizes a risk matrix with defined likelihood and impact scales, incorporating expert workshops and scenario analysis to identify and prioritize emerging risks. Option B. Replacing the current process with an unguided, open-ended brainstorming session among senior management to identify potential risks, with no defined criteria for evaluation. Option C, shifting to a purely quantitative risk assessment model that relies solely on historical loss data and statistical modeling to identify and quantify all potential risks. Option D, focusing exclusively on risks with a high frequency of past occurrences, using historical loss data as the sole basis for qualitative risk assessment. The correct answer is A, implementing a structured qualitative risk assessment framework that utilizes a risk matrix with defined likelihood and impact scales, incorporating expert workshops and scenario analysis to identify and prioritize emerging risks. Explanation: this scenario is professionally challenging because it requires an insurer to balance the need for efficient risk assessment with the regulatory imperative to conduct thorough and accurate qualitative risk assessments. The challenge lies in selecting a method that provides sufficient depth and insight without becoming overly burdensome or subjective, ensuring compliance with regulatory expectations for understanding and managing emerging risks. Careful judgment is required to ensure the chosen approach is both practical and robust. The correct approach involves a structured qualitative risk assessment that systematically identifies, analyzes, and prioritizes risks based on their likelihood and impact, using expert judgment and defined criteria. This aligns with regulatory frameworks that mandate a proactive and comprehensive approach to risk management. Such an approach ensures that the insurer can identify potential threats and opportunities, understand their potential consequences, and develop appropriate mitigation strategies, thereby fulfilling its duty to policyholders and maintaining financial stability. This method provides a clear audit trail and justification for risk prioritization, which is crucial for regulatory scrutiny. An approach that relies solely on historical loss data for qualitative assessment is incorrect because it may fail to identify emerging risks or risks with low historical frequency but high potential impact. This overlooks the forward-looking nature of effective risk management and can lead to regulatory noncompliance if significant new threats are not adequately considered. An approach that uses a purely subjective, unguided brainstorming session without defined criteria or prioritization mechanisms is also incorrect. While it can generate ideas, it lacks the structure and objectivity required by regulators. Without defined criteria for likelihood and impact, the assessment can be inconsistent, biased, and difficult to defend, potentially leading to misallocation of resources and inadequate mitigation of critical risks. A purely quantitative approach, while valuable, is insufficient on its own for qualitative risk assessment. Qualitative assessment is designed to capture risks that are difficult to quantify or are in their nascent stages, requiring expert judgment and scenario analysis. Relying solely on quantitative data would miss these crucial qualitative dimensions, leading to an incomplete risk profile and potential regulatory breaches. Professionals should employ a decision-making framework that begins with understanding the specific regulatory requirements for qualitative risk assessment within their jurisdiction. This involves identifying the types of risks that must be assessed, the expected level of detail, and the acceptable methodologies. The next step is to evaluate potential qualitative assessment approaches against these requirements, considering their ability to identify a broad range of risks, incorporate expert judgment effectively, and provide a basis for prioritization. The chosen method should be documented, consistently applied, and subject to periodic review and refinement to ensure its continued effectiveness and compliance.